morning. Welcome to Coffee with KPP Live, the show that's dedicated to providing you with advice for life so that you can live richly and work towards the life that you've earned. My name's Kyle Roy. I'm a financial advisor with KPP, joined with president and co-founder of KPP, Ken O'Neill.
Thanks.
Hey, thank you, and thank you for joining. This show is one of those things that, you and I, by the way, have a lot of fun together. Our team, serving the clients that we do. And today's show is right in your wheelhouse because I have met very few advisors that are as passionate and as convicted about life insurance as you are. Now, and if those of you out there, you see life insurance, nobody wants to talk about life insurance. Nobody wants to talk about death and dying. But quite frankly, when you're building a comprehensive financial plan, hoping for the best, preparing for the worst is what we do. And Ken, in your 20 years experience, I know you're going to tell stories of how life insurance has protected people, how people didn't want to buy life insurance and their family members, thank God that they did. And we're going to walk through the basics. These aren't going to be sales gimmicks, sales pitches. You're just going to use your 20 years of knowledge and help the audience understand what they need to be thinking about with life insurance without being sold a product.
Right.
Okay?
Basically, life insurance 101, Kyle.
Perfect. I love it. No gimmicks, nothing. What do you need to be thinking about with life insurance?
Well, again, here at Kentucky Planning Partners, because we are a comprehensive financial planning firm, we really feel it's important to make sure our clients look at what's the possibility, what would happen to my family, God forbid, if I was to die or be killed in an accident or disabled. But today we're talking about life insurance. So one of the most common questions we often get is, how much do I need? And so we have two very sophisticated software programs that we use during our planning efforts here at Kentucky Planning Partners. And those are great, and those will help us determine that. But many, many times, I'll go back to the old school 20 years ago. Let me pull out my legal pad and write down DIME. So the way I've remembered this through all these years, just remember DIME.
So the acronym DIME. So in other words, we have all the sophisticated software. If you want to sit down and find out exactly in the planning process mathematically, we can figure it out, and you might be overwhelmed by that, or it might be intimidating to walk through that. Sure. But when you were walking through this system, I was reminded of the line, there's no school like the old school. Right. Keeping it simple. It doesn't need to be that complicated to find out how much life insurance you need, and it doesn't have to take that long. And I think this DIME acronym is absolutely brilliant.
Right. And so we're going to talk about that, and we're going to talk about the different types of life insurance and what type is right.
Okay.
So on the DIME, the D stands for death. That's basically burial cost and things of that nature. It may be anywhere between $15,000 and $40,000, depending on what you want for yourself or your loved ones.
So death is how much does it cost to put me in the ground, effectively? Right. So cremation costs, burial costs, and having gone through recent death in our family, we realize how quickly those costs add up. Even flowers. It's just incredible. And $30,000-$40,000 just for the cost of burial. That's about average, isn't it?
I would suggest a little less than that, but it can be substantial.
Okay, yeah.
And so the second would be, this is one of the bigger ones, is income replacement. So when we're working with a family and a couple, it depends on if one spouse is working or both spouses working, but if the husband or wife, let's say they're both working, what is the right number of income replacement? Meaning if you make $75,000 a year, and both spouses make $75,000 a year, so the family income's $150,000. How much would each spouse want on each other's life to say, look, I want to make sure, A, that you can stay in the house and that you continue life for a certain amount of time or years. Now, that is a very, very, very personal choice. There are some general guidelines that we have, but at the end of the day, that is something that both spouses need to look at each other, and they may not be able to give you the answer at that moment. They may want to go home and talk about it. But often we'll see, well, I want to make sure for at least 5 years my income is replaced. It might be 10. It might be 15. Again, that's a very personal choice. But I always say it's kind of like a football. It's like kicking a field goal like this. as long as it's in these parameters, it's okay. You just want to make sure it doesn't get shanked that way and say, I think 6 months is plenty.
Yeah, so if you're making $150,000 a year and you want to know if you pass away, your spouse has enough money to bury you and have that income replaced for 5 years, well, that would require $750,000 of life insurance at least. So 150,000 times 5 is 750,000 plus another $30,000 in burial costs potentially.
Right.
So those are that's if you wanted 5 years.
Right. And then many people would say and would consider the M in the dime equation is mortgage. To have a $300,000 or $400,000 mortgage, oftentimes when the couples look at each other, they say, you know, if something were to happen to you, honey, I would like to make sure that the mortgage is paid off. Mm-hmm. And so that is often a component of the equation for which people, when they really sit down and say, how much insurance do I need is enough, they will often consider the mortgage. That's the and the last would be the education. That means the education of the children, and in some cases, grandchildren, depending on the circumstances.
Sure.
And many times, if you have 2 kids and you know they want to go to an in-state university, there's programs we have that will predict how much U of L, U of K, or Western Kentucky will cost in 6, 8, 10, or 12 years, and they'll include that because many, many times when we've had this happen, the surviving spouse will come in after the dust is settled and they will say, look, I want to make sure my 2 daughters and 1 son will have at least enough for a local university, and we'll look at the funding options, which is very typically a 529 account. Mm-hmm. So those are the 4 different parameters that are often covered in what we call the old school way of determining the amount of insurance. And I'll stress again, at the end of the day, it's very important for the family to make educated choices, but in many aspects, that amount is still, it's a variable amount depending on the mortgage being totally paid off, and particularly the income replacement. That's something that couples often need to sit back and really put some thought into.
Yeah, so just in the last 5 minutes, so what we were able to break down a client family that might be in their mid-30s, earning $150,000 a year with a $400,000 mortgage and, let's say, 2 small children. So the DIME, we'll walk through each one, I'll summarize it. Death would be, let's say, $30,000 of protection on the high end. Income replacement for 5 years would be $750,000. Right. So that would be $750,000 plus 30, we're at $780,000. Let's say with a $400,000 mortgage, that puts you up to $1,280,000 if you wanted that mortgage paid off. And let's say each child was going to go to UK in 10 years or so, and that would be about $100,000 each. That's another $200,000. So you're right at about $1.5 million life insurance need, right, give or take. And again, I love your goalpost analogy. That's within the goalpost. So within 5 minutes, without having even met a client, that might give you an opportunity to kind of say, oh, all right, that makes sense. So what's next? I know how much insurance I need. So what's next? Do I go out and do I want to find the most expensive policy possible? I mean, everybody's bragging to their friends about having the most expensive insurance, aren't they? Yeah.
Insurance salesman's dream, I think. It's a very good question. First thing you need to look at is how much you have at work. Do you have any group insurance at work? Oftentimes, you can buy additional insurance at work, and it's much cheaper. But I want to make a pause here. Sometimes it's not. What do I mean by that? If it is a group of physicians and you are the youngest physician and there's 75 physicians in this group coverage, many times depending on the group, I always say get the pricing that you can at work. You get a free amount, of course, you're going to take that. Find out how much it costs through work to get additional term insurance. And oftentimes that's the right way to go for a portion of that, because if you can save money, save money. Mm-hmm. But if you're the young guy, and let's say it's a group, let's say it's a big group. Well, a lot of times if you're the young 28-year-old out of college that's married with a child or 2, you can get term insurance so cheap that it's even cheaper than the group insurance, because the group may include 40, 50, 60-year-old folks, many of them that don't have good habits or they have had health problems. So group insurance is good because normally there's little to no underwriting and you can get additional. But again, you just want to make sure, hey, if I'm going to get it at work, can I get it outside of work cheaper? Because that's the better option if you can save money. And remember, if it's outside of work, which is another thing that may be beyond the scope of this, I always think it's wise to have a little bit of life insurance no matter what outside of your job, because we all know that the most secure job can become unsecure in today's world.
That's right.
So, oftentimes we always say, you might want to look at having some insurance outside of work. For instance, when I left Colgate-Palmolive, 20-something years ago, I went from having like $700,000 worth of insurance. When I stepped my foot on the pavement to do this, I had zero.
Yeah.
So it would have been wise probably back then for me to have a little bit of insurance. But here I am. I'm still breathing, so I didn't need it.
But we'll talk about that. It's a really good point. But I think going back to that group coverage is really important, because you just think you're going to get the best rate through work. And by the way, as fiduciaries, executing a fiduciary standard here at KPP, we're not in the business of solely selling life insurance, right? So when we build comprehensive financial plans, we'll guide you. We'll guide our clients to help them understand their group plan. But it's so important to note that if you're a younger individual, younger employee, you may not benefit from the group plan as much as somebody in their 50s and 60s might, right?
Exactly.
So just knowing what your options are key. And you said, well, you're not dead yet, but do you regret paying for life insurance? Does anybody cut their life insurance check, that premium check every year, and they say, this is it, Ken? This is the year.
I'm gonna collect.
This is the year it's going to become a good investment, right? Like, nobody wants to die to have their life insurance become a good investment. But let's move on and talk about some of the other options. Okay, so group insurance, and I love that you brought that up first, because generally that's going to be the most cost effective for people.
Sure.
But understanding your options.
Well, you can't beat free, or it's included in your benefits of your employment. So you can't beat that. So, the next step you look at is, if you're really concerned, as part of the comprehensive plan, I would say, look, it's an ancillary byproduct of what we do here at KPP, but it's an important ancillary byproduct of that, because, you don't want to be left out on that island, particularly after losing a loved one already. You have enough problems in your life if you lose your spouse or loved one. So the next type is the two basic types. And again, we're going to scratch the surface here, but I'm going to include that in two basic types: term insurance and permanent insurance. Term insurance means just this. It's for a certain term. Typically it's 10 years, 20 years, or 30 years. Sometimes there's some in between, but we're going to stick with that for this. So basically, you go through and you say, I think, well, my kids, they're 10 years old, or they're 12. Let's say you have two kids, and one's 14 and one's 12. And your mortgage is half paid off, and you just want to make sure for the next 10 years, if something happens to you, your surviving spouse can pay off the mortgage, and the kids will still go to college and a little income replacement. So that is the cheapest insurance you can get, because there's no cash value, and it's for a very short term. The term is 10 years in this case. But you may need 15 years, you may need 20. So the longer the term, the more expensive it gets.
And the more expensive it gets, because the longer the term, the greater the chances that you're going to die in that period, and the insurance company accounts for that. So the longer the term, the greater the protection, the greater the cost.
Right. The more risk they take, the more you're going to pay to provide that coverage for a longer duration. And you have permanent insurance. And a lot of people say, wow, Ken, why is permanent insurance so expensive, or so much, relatively speaking, more expensive? And there's a real simple answer to that, and it's very cheesy, because I can say permanent. One thing I can guarantee you is that in one day you're going to die.
Guaranteed.
It happens.
It's
And so
gonna happen.
permanent insurance is just that. It's permanent. It's there for your whole life. So it is going to eventually pay. That's why it's more expensive.
That's right.
So a 20-year-old buys a 20-year term policy. He's very unlikely he's going to die between 20 and 40, statistically speaking. But you get someone that's in their 60, and you say in their 60s, and say, I want a 20-year term. Well, guess what? Statistically speaking, between 65 and 85, there's a lot higher chance that you're going to pass.
That's right.
That you're going to die. So
It's going to be more expensive for older people.
And so many times, and some people say, look, just buy term insurance and invest the rest. And I think, matter of fact, some of the people, the gurus out there, look, buy a term and invest the difference. Well, my experience is this: most people that say that, they buy term insurance, and what do? They
Spend it.
They spend the rest.
That's the risk.
So many times it's a combination. You know, I think if you typically look at who owns permanent insurance, it's either an old whole life policy that they've had for years and years that maybe their parents bought for them, and they want to keep maybe, I want to have at least 50,000 no matter what, just to cover the. I just want to cover my funeral and make sure if something happens that somebody's going to get a little bit of a windfall.
You know, there's so many ideas out there too. We teach Social Security classes. We've been doing that virtually. We're starting to do it in person. And I've taught these classes all over. And a lot of people say, well, I'm going to take my Social Security early. I don't really need it, but I want it to, if I die and don't take it, nobody gets it, right? Well, we've seen people at 62 start taking Social Security and buy a life insurance policy, a permanent life insurance policy, to make sure that they're turning Social Security into a life insurance. So there are into a legacy, so to speak. So there are infinite ways that life insurance can be used, whether it's term, permanent insurance, what your goals are. There's not a one-size-fits-all to these investment solutions. You can do anything with them.
And there are policies that have, the ability to accumulate cash value, and which they say you can take a loan or take a disbursement out of it. And, it all depends on your situations. Many times we find that our wealthier clients, it is often a very suitable choice for someone that is in a higher income bracket because they can grow the money tax-free, and there's a lot more flexibility for taking loans out down the road. So there's not a which is the best type. The best type is it depends on the circumstances of where you're at and your understanding. And some people just they're very legacy oriented, meaning some clients say, look, I want to make sure no matter what, each of my kids get $250,000 and I've done well, but I want to make sure they get this. And so that is often a very suitable way. And then we have people that say, look, I've paid for 3 weddings, I've sent all my children to college, they're going to be fine. I just want to make sure myself and my spouse are okay.
And what's the biggest advantage for the beneficiaries that receive life insurance proceeds?
They're tax-free and properly structured. Again, this is a very scraping the surface. Most of the time, in almost every case, it's structured properly. It is 100% tax-free, so no income tax, no inheritance tax. As long as you properly structure it, it's a very good, safe way to make sure that someone gets some money tax-free.
So effectively what we're looking at here, I love it, the DIME methodology. If you are in the accumulation phase, so if you're in that part of your life where you and you're building your family and you're building your wealth, well, protecting that wealth that you have in the event of your passing, the DIME methodology, I think, is a simple, easy way that you can at home determine how much life insurance you may need. And give us a call at KPP. We can help verify that for you and build a comprehensive financial plan to help it all work together. As we move up the experiential timeline, so the older you are, life insurance can become a lot more sophisticated. Generally, we want to use life insurance to protect legacy, right? Life insurance is primarily used for a death benefit. That's the primary purpose. But the more complex a financial plan becomes and an estate plan becomes, the more creative we can get in implementing these types of solutions to maximize effectively what you want your money to do for you.
Sure, a lot of it's personality driven. They just say, look, I need it till I'm 65 years old. I want to do it as cheap as I can, and that's obviously term insurance. Depending on your financial circumstances, many folks have a combination of both, because they may want a policy that's going to be there as a legacy, but after a certain age. So a lot of times it may be a combination. I think one of the more important things to talk about is how is it priced, and I'm going to spend a couple more minutes on permanent insurance. I think we've all heard of whole life policies. They've been out there forever, and often your grandparents had them and your parents had them. And the good thing about whole life policy, if it looks at the cost, the underlying inside the policy, it's called what we call in our industry COI, cost of insurance. On a whole life policy, the thing about it, it's a level line. So if you buy it when you're 20, the cost of the insurance is levelized, statistically speaking, throughout your life. So you tend to pay more for it in your 20s, and the cost of the insurance is the same throughout the life of the policy. So obviously when you're younger, compared to other types of permanent insurance, a whole life policy may cost more. But you know what's good about them is that because they equalize that cost of insurance throughout the life of the policy, it often survives.
And
It survives because other types of permanent insurance, index policies, variable policies, universal policies, the underlying cost of the insurance inside the policy gets to be more. What do I mean by that? I'll allude back to what we talked about earlier. When between the ages of 20 and 30, statistically speaking, there's not a high likelihood that you're going to pass. 30 and 40, a little bit more, but not much. 40 and 50, it starts to, but when you get to your 60s, 70s, and 80s, the cost of the insurance, I mean, what are they going to pull out of your premium and cash value to cover that death benefit, goes up exponentially because we all know you're a lot more likely to die between 70 and 80 or 80 and 90 than you are between 30 and 40.
So this is one of the reasons why a lot of people hate insurance companies, quite frankly, right? Because how many times they hear stories of their parents or their grandparents getting these bills for these life insurance policies that are so outrageous that they might have been paying on it for 5, 10, 20 years, but it doesn't make sense to cut that premium check because it's so much. So that's where those policies where the terms can change.
Sure.
But how can you protect against that? So with a term insurance policy, you know once the term is up, so if you buy it at 30, a 30-year term ends at 60, you can expect to pay more at 60 than what you were paying because the term's up. A whole life, it sounds like, if you buy it at 30, can you be confident in knowing that that premium's not going to go up even when you're 60? So it might hurt when you're younger, but you might be thanking the good Lord that you have that whole life policy when you're in your 60s because that payment will be so relatively small.
And you know, and I'm not here pushing whole life.
No.
Or in the world of permanent insurance, again, I hate to say it all depends, because many of the variable policies or universal, whether it be a fixed rate of growth, or particularly I always say be real careful with the variable policy that maybe has investments in it that you can invest in. They call them sub accounts, but they're mutual fund sub accounts. Those can really potentially get in trouble if you're in your 60s or 70s and you have a lot of cash value in the market, because obviously if the market has a real bad 2008 type of year, all of a sudden you're sitting there and you said, wow, I've had this thing 30 years, and all of a sudden you get a bill. It's like, in order to keep this thing afloat. So one of the things you can do,
And that happened.
Yeah,
That happened.
I've had it happen several times. One of the things you can do on some of these other types of insurance policies, they have guaranteed till a certain age. Often it's 90, many times it's 100. So depending on what you feel safe, you can say, look, no matter what type of insurance policy I buy in the permanent realm, I want to make sure nothing goes wrong till I'm 100. So if something happens with the interest rates that they're paying or with the investment side of it, it's always going to be good, even if it runs out of money inside the policy until a certain age. That's the way you can protect your family. And those are the things, if you're really concerned about legacy, that's the only ones I really feel comfortable with. Because the last thing you want to do is own something that you have to have 40 years in order to collect, and 37 years in, it collapses. That is not a pretty picture, and you're not happy, and your family's not happy. So we want to make sure when we work with our clients, they understand the type of insurance they got, they understand the type of insurance they need, and they understand the amount of insurance that they actually have to have.
Yeah. So it's not a matter of trust us. It's a matter of doing the work, making sure every client understands what they're getting into and managing expectations. And from what it sounds like, the less expensive you get, you're looking at term with an expectation that it's probably going to be more if you live beyond the term.
Right.
Now, and again, you might be sold this idea of variability, variable universal life, and we can utilize those solutions and things like that. But the bottom line is there are risks involved there, and the more variability you have, the less predictability you have in the future.
I'd really like to stress one more thing, is that you really want to, as an independent firm, you really want to, in my opinion, you really want to make sure you work with someone that has access to many different carriers.
All carriers.
Because some carriers work better with people in a certain age range, or they work better with smokers, or they work better with maybe type 2 diabetes.
Yeah.
And so here at Kentucky Planning Partners, because we are fully independent, we don't just work for, this is who I work for, XYZ insurance carrier.
Yeah.
Because you want to make sure you get the most for the money. And I don't want this to sound crass, but a lot of times life insurance, term insurance, and permanent insurance, it's a commodity,
That's right? Shop it out.
You want to shop it out and get the best deal for you and your family. That's what we do here at Kentucky Planning Partners. We shop it out based on the client's needs, and we get them the most that they can get for the money. And we also make sure that they get the right amount. We're not trying to always say, you got to have 30 years of income replacement, because sometimes that's just not realistic for the family, nor want it, nor need it.
You know, and I would say too, it's funny. I've had friends and new clients come on board in the last year. If you have in your gut this idea that you've been sold a product by your current advisor, give us a call at KPP. We'd be happy to review it. Generally, if you walk into an office and the name of the company is on the side of the building, and then the application that's put in front of you has the same name of the company that's on the side of the building, you're working for an agent of a firm that gets paid based on how much of that product they sell. And to Ken's point, to have an independent structure with the solutions that we end up putting in front of our clients have been put through filters that we have representatives help us find the best companies. As long as we know and trust the company is well run and it's going to be able to back its promise, we're going to be confident in putting it in front of you, because again, nobody's ever bragged about overpaying for their insurance policy, and to be able to shop out, to have insurance companies compete for our business to offer you, it ensures that you are most likely going to get the best pricing. And we could show you all the lists of the pricing that we got to make sure it's as transparent for you, so you can have the confidence of knowing that you weren't sold something, but rather you know why you invested in that policy, how it fits with your overall plan, and how it will help you accomplish your long-term financial objectives.
And you know one thing particularly about life insurance? It's real easy to tell if you're not with us anymore. So it's going to pay us. That's a terrible joke. If you're not breathing, that policy will pay as long as it hasn't collapsed. So we'll end on a very cheesy bad joke.
Yeah, no, I like it, but that's the thing. I always love it, because it's like with life insurance, it's one of those things where it's tough to talk about. People feel like they're always being sold life insurance. A lot of people say, I don't believe in life insurance, I'm never going to talk about it. Well, the bottom line is, when you're working with a comprehensive financial planning firm, you're going to be able to see the cost of owning it, the cost of not owning it, the risks that you're exposing your loved ones to. And I promise your last breath on God's green earth will not be, thank goodness I paid for that life insurance, right?
Exactly.
But you're with your, it's one of those things where you're not going to regret it if you have it, and your family will be better off if it's the right thing for you. So.
Right.
So with that said, I know we said we were going to talk generally about it. I love that we get into the weeds, because Ken, you skim the surface of your knowledge on these investments. So if you have questions or concerns, give us a call at KPP. Ask for Ken and anybody from our team just to do a review of the plans that you have. If this is something that's on your mind, if you feel like you have been sold a product that might not be appropriate for you, we'd love the opportunity to help you, consult you, and make sure that you understand how every single part of your financial life is sticking together. So with that said, thank you for watching. We're located at the Flash Cube building, the heart of Louisville's east side, on the corner of Shelbyville Road and Hurstbourne Lane on the east side of Louisville. Our phone number is 502-394-0400. Give us a call anytime. We look forward to seeing you soon.
Thank you.